Hi everyone, and welcome to the BDFM Investment Dialogues, Taking Control, How to Use ETFs to Build Your Wealth, in association with the Johannesburg Stock Exchange. My name is Nastassia Arendse and I will be your host for today's session. So the conversation we're going to have today ultimately builds on two previous events that we had earlier this month. The first one, we looked at the ever-changing role of financial advisors and the growth of ETFs. And in our second installment, we brought you equipping financial advisors, taking a closer look at ETFs. So this conversation ultimately is for you. This is where you can ask as many questions as you like. Anything that has been burning through your mind over the years around ETFs, that is what this conversation is about. So the financial uncertainty that was brought on by COVID-19 has brought on to the fore the importance of having to take stock and reevaluate our financial position and actually building a long-term plan. Opening up conversations like this on investments allows you to be able to take the tools that we discuss and see where you are when it comes to your financial journey, because after all, it is a journey. And you'll see as the conversation unfolds, you'll get to understand the beauty of ETFs and the role they've played in the financial industry. And we've got a fantastic panel to have that conversation with. Before we actually unpack the ETF industry, the benefits of investing in an ETF, I'd like to welcome to the stage Itumeleng Monale, who's the Chief Operating Officer at the Johannesburg Stock Exchange, and she's here to give you the official welcome. Itumeleng, the virtual platform's yours.
Thank you, Nastassia. Good afternoon, everyone. I've heard nothing but amazing feedback from industry colleagues about the Business Day Financial Mail Investment Dialogues. These conversations are really important and supported by the Johannesburg Stock Exchange because they provide an opportunity for us as an industry to take stock of trends and developments, as well as draw from the rich knowledge of the experts that we have here today. The psychology of investing, commonly known as behavioral finance, is aligned to one of the key initiatives that we are quite energetically pursuing at the JSE. We're currently collaborating with the financial markets ecosystem to create and help grow the retail investor segment. Although still gaining early momentum in South Africa, behavioral science first became popular after Daniel Kahneman and Amos Tversky won the 2002 Nobel Economic Sciences Award for their contribution to this topic. And the theory is of particular importance because it describes how investors behave irrationally in the face of uncertainty. And as humans, I think most of us can relate to the irrationality that we sometimes display, especially in times of instability. One of the major contributions to this irrational behavior, I think, is the plethora of information and the abundance of it available to investors today. You have all kinds of information varying from trend-based, fact-based historical analysis to expert opinion and even public opinion. And therefore, financial education becomes really important, not only for investors, but also for the financial advisors as well, because financial advisors themselves play a critical role in guiding jittery investors through times of uncertainty. I think it's really critical to also realize that as investors, we do display certain biases in our choices. And if interested, I would recommend a book by Jay Morland, who published an Amazon bestseller called The Emotional Investor. And it talks to really how biases influence our investment decisions. So as you may have heard, there are many asset classes that people can invest in. And I think that the audience today, being mostly retail investors, are really interested in some of the asset classes that are available to you and being a responsible investor. So today we're talking about ETFs. And you may know that the JSE offers ETFs across various different asset classes. We have about 53 equity-based ETFs, 28 of which are local and 25 international. We have 12 bond ETFs. We also have ETFs in terms of property as well as commodity-based ETFs. So as you can see, there's a myriad of asset classes behind the options that are available to you. And with so much choice, I think it's fair that education and awareness get partnered with sound advice from your financial advisor. And that's really what we're here to do today. As you also might have known, the investment value chain in South Africa in particular to date has really been most efficient for the institutional investor. However, the JSE recognizes the growing retail investor market, and it is very important for this market to grow and therefore also have a huge healthy need. I think the retail investor has a healthy need for trustworthy and thriving ecosystem so that you can access these financial markets. So with the plethora of information available today, I think the advisors and the experts that we have on the panel will be of great assistance. And what we want to do is ensure that the investor base, such as yourselves, interested in this asset class and making yourselves much more worthy investors going forward with the information available, that you enjoy today's informative session. And I'll hand back to you, Nastassia.
Thank you so much, Itumeleng. That is Itumeleng Monale, who is the Chief Operating Officer at the Johannesburg Stock Exchange. And she's really highlighted some important themes that we can't forget here. And I think that is where the importance of these kinds of conversations come into play, because it's all about helping you achieve your long-term financial goals. And we'll certainly be doing that. We do see some comments and questions that are coming through. Remember, keep them going. As the conversation unfolds, we'll try to answer as many questions as possible, and probably even provide a platform to answer any questions that we do miss, because we want you to be able to reach your financial goals. So Itumeleng mentioned something that was quite important, and that was about the biases that we all establish around, our finances, around money. Money can be such a sensitive topic, especially when you bring in the idea of investing. Robert, I'm going to start off here with you. I mean, when you think about this period that we're in, which is, I suppose, crazy for lack of a better description, what have you learned about your clients when it comes to their behavior, especially when it's, when we're panicking and it almost feels as though the world is coming to an end?
Yes, so thank you for inviting me to this panel. So in terms of client behavior or retail behavior, it's quite interesting. And I always get reminded of the quote by John Bogle, who is actually the father of, let's call it ETFs and index mutual funds. And he mentions that the two greatest enemies of the investor is costs and emotions. And I think it's quite interesting to look at the emotional side as well, with the event of behavioral economics and then the subcategory behavioral finance, which is filtered through into where we're playing at the moment. And it's also interesting at the moment, just talking of emotions, there are about 183 biases out there at the moment. And just out of interest as well, a bias of a bias is when they add a new bias. So it's totally getting out of hand in terms of the biases, but there are broadly 20 big ones. And in terms of the market and what we've seen as well, depending on the market cycle, people go through these emotional things called biases. And what has also not helped in the last period is that we've also seen a lot of new words appearing on the lexicon of investments. We've seen the words FOMO, fear of missing out. So when the market suddenly returned last year in March, we saw the market going down to losing about 37% and the market recovered. Then we saw clients phoning us in terms of fear of missing out. We've also had clients, the other one is FOGO, the fear of getting out. So these are all new terms that have popped up in this period. Diamond hands, for example, in the old days, it was like blue chip shares, hold, invest and hold forever. So I think on the emotional side, it is important. We do see emotions running quite raft during periods of exuberance and in periods of a lot of fear. I got involved in this a while back, and I actually wrote a book called, if I may show it, called The Money Fountain, where I addressed the idea of investing in ETFs, because one of the biggest problems for a lot of people investing in the stock market is the paradox of choice. There are roughly about 403 shares at the moment. What do I get in? Unfortunately, the paradox of choice has also crept into ETFs because We've got about 160, including ETFs and ETNs, on the Johannesburg Stock Exchange. So we are dealing with all the emotions that were experienced by investors in terms of investing in stocks. Now we're experiencing the same emotions in terms of investing in ETFs.
Robert, Nerina, let me come to you. Do you concur with what he was saying in terms of some of the stuff you've learned about your clients?
Yeah.
Perhaps the good, the bad, the ugly in terms of the lessons learned there.
Indeed. Thanks, Nastassia. Yeah, I think if I think of the good side, I think in the early days in particular, we found that clients had more time. Clients were able to engage with their finances. They were looking at their budgets. They were looking at their investments. They started asking very good and very probing questions, and that for me was really good about it, and it's sustained. We see more of that, and I think that's why an event like today is so great, because that's why people are engaging. But I think maybe one of the worst things, the bad things that came out for me, was that clients, because of changes in their personal financial circumstances, realized where investment options are inflexible. It really hurts. So here I'm thinking of people who lost their jobs or had a cut in their salary and who was tied into investment options where you're contractually bound to pay the same monthly premium or else lose benefits that you'd already accrued. And I don't think it's something that we appreciated prior to COVID, how important it is to have that flexibility in your investments. I think the worst for me, the ugly side of it, and I think Tumeleng referred to it as well, the plethora of information that is available. We are absolutely overwhelmed with information, and I think people are consuming more social media information rather than be discerning about good quality information. And that ends up in a lot of the behavioral stuff that Robert is also talking about, where people are now responding and reacting inappropriately because they are not sufficiently discerning about the information that they consume. So there's been some really good developments with clients over the last 18 months, but I think there's some definite warning signals also, and it would be useful for retail investors, I think, to be aware of these biases that they bring into their own investment decisions. Once you're aware of a bias, you can actually address it and you can counteract that bias.
Yeah, and I suppose even if you weren't in that situation where you were caught in inflexible products, it's forced you to go back to your financial advisor and re-look at the terms and conditions that are in the document you may have signed 5 or 10 years ago to still make sure that you understood everything that you signed in case things change for you. Let's come to you, Vemera. Is the situation still the same as Nerina just alluded to?
I think a point Nerina made, as well as Robert, is this digital transformation and people getting more comfortable with interacting digitally, consuming information, has created a world that has become, I think, smaller to a degree. Even in South Africa, you can now interact with the advisor. Nerina mentioned it earlier in our conversation. You can be a Joburg base and interact with the advisor in Cape Town and have a relationship without being in the same city. And I think similar with investments from a choice perspective, you in the past, you looked only towards locally produced or accessible information and products, and now it's easier to interact with global platforms, global products. So that choice is great if you know what you're doing. If you don't, it can be overwhelming and actually, I think, be paralyzing at some stage. So there's a balance between having access to information, good quality information, product, and then making a decision for the right reason. And that's where I think a financial advisor actually has got a role to play, is not only making the right decision, but also helping you stay on course when these biases or emotions come up in time of volatility or uncertainty, to help you say, staying the course long term does pay off.
Yep. And we'll talk about whether it is possible to do it on your own, especially when it comes to ETFs, or whether you should actually outsource and get a financial advisor, and also what to do with the other pieces of information that may be lurking around the internet. But let's go back to basic before we even get to that. Let's unpack what an ETF is, Nerina. And I know, and we've had this conversation before, you have an amazing acronym for people to remember what an ETF actually is. So what is an ETF?
So the acronym that I often use is, I know that an ETF stands for an exchange traded fund, but I prefer to think of it as an efficient, transparent and flexible investment opportunity. But yes, jokes aside, I think an ETF is probably best thought of as a listed index tracking unit trust. Each of those three components have got relevance in this conversation. Exchange traded tells you that it's listed on the stock exchange. That talks about where do you buy this investment product? How do you access it? The fact that it is index tracking, in some colloquial terms it's referred to as passive investments. I prefer the index tracking term because what an index really and an index tracking portfolio does, I like to think of it as a recipe. The recipe tells me what are my ingredients and the quantities that I need to make the particular thing that I want to make. And that's really what an index is in investments as well. It tells you what are the constituent companies or the securities that need to be in there and how much of each of them. And then the final component, the fact that it is a unit trust, I think is incredibly important from a regulatory and a safeguarding perspective. So many of the retail investors would be familiar with unit trusts, also referred to as collective investment schemes in South Africa. And that really talks to the regulatory form in which those assets are held on behalf of the investors. So the investments inside an ETF does not belong to the ETF issuer, being a One Invest or being a Signia or being a Satrix or whatever the case might be. It actually belongs to the investor and it is safeguarded and protected by an independent trustee which is required to oversee that ownership of those assets. So some really important components, I think, but ultimately it's about efficient, transparent and flexible access options to investments.
Yeah. Vamira, let's come to you. I mean, Narina's, discussed what an ETF is, but then oftentimes our viewers may have seen this. They'll see ETF, they'll see ETN. What is an ETN and what is the difference between the two?
That's a good question. And I normally, similar to Narina, I think about index tracking as a strategy, and I think you can deploy it in different ways. So you can, let's say as an investor on the JSE, and you want to track the performance of the top 40. You can go and buy a future, and you can achieve the top 40 performance. You can buy the physical shares. So you can go and buy 40 shares on the exchange, but that's not efficient. And I guess that comes back to Narina's efficient. You can buy an ETN, and an ETN is normally issued by a bank, so from the bank's balance sheet. And what they do is they promise you that they're going to pay you the return of the index. But the important point Narina highlighted, an ETN might give you the same return, but in case of an adverse event like a default where the issuer or the bank has got a credit default, then you're in line with the other creditors to go and get your money because your money is not ring fenced. And that's where ETF is on the top of the pile for me when it comes to if you want to achieve top 40 performance, because you've got the ease of transacting in it, you've got the performance, plus you've got a guarantee if something bad would happen. So ETN ETF from a payoff perspective should give you the same return. The ETF just adds another layer of, let's call it security or comfort, because it's a CIS, plus it's on the JSE, so it adheres to the listing requirements on the JSE. So in my mind, it's the most efficient from a cost tax perspective to access something that you can go to bed at night knowing that your money is safe, which I think we'll get to later in terms of making a choice between ETF providers and ETFs versus other instruments, I think.
Remember to keep those questions coming as this conversation unfolds. We will answer those questions that you want answered. Robert, let's come to you in terms of, you were mentioning how many ETF products there are out there and ETNs as well. And I suppose the question then becomes, what makes a good ETF? Is that even a logical question for one to be asking?
That's a very good question. So usually, you have to answer your why. Why are you investing in an ETF, and what are your reasons? So the reasons are basically, it could be to supplement income, it could be to create wealth, it could be to grow wealth. There are a lot of reasons. So I think once someone has established the reason of why, then it becomes a choice question. And then the question would be, and there's a lot of debate about passive and active investing. And for me, it's basically around three things: your knowledge about the product, your strategy, and then how you're going to execute it. So if we come to ETFs, you don't need a hell of a lot of knowledge about it. But what we do know, for example, let's use the top 40. On average, that top 40 actually produces an annual return of about 10%. So that's good knowledge. The second thing is in terms of executing it is quite simple. You don't need to go through tactical asset allocations and wait for the timing and things like that. So my departure point with clients would be, firstly, if they do want to go the ETF route and they want to do it self-managed or do it yourself, is to ask you, why do you want to get into it? The second thing is basically to understand this is a minimum 3 to 5 year plan. And then thirdly, the recommendation would always be to start simple. So we big proponents of what is known as a core and satellite approach, where the core would be an index tracking. So for example, the top 40. And once you get comfortable with that, you can start diversifying into, interesting things like commodities or properties or fixed income. But just to get that bed of knowledge and comfort around the most basic of ETFs, which is an index tracker.
All right. So when it comes to, and you were talking about index products, some people might equate ETFs with index tracking products. Is that the same thing, or are we talking about two different things here?
Oh, Nastassia, that's a great question, because a lot of people do think that it necessarily equates. And the reality is that in South Africa, the majority of ETFs are also index tracking products, but it doesn't necessarily have to be just that. Good example already in South Africa, think of commodity ETFs. They hold a single commodity, a gold ETF, a platinum ETF, for example. So in that case, the ETF does not track an index by that matter. In US markets in particular, actively managed ETFs are already available, and certainly in South Africa, on the ETN side, some of the products that we've got there are also actually actively managed. There are index tracking options within the ETN space, but there are also actively managed products. So let's not confuse ETF with index tracking, even though the reality at the moment is that the majority of them are indices. But I just want to follow on from something that Robert also said in response to your previous question. For me, there really is no such thing as passive investment, because ultimately, as the investor, I have to make an active choice of which ETF I'm going to be investing in. Robert mentioned it in his first answer, more than 80 different exchange-traded funds, almost 160 exchange-traded products on the JSE. That's a very active choice to decide which of those I'm going to be investing in. So also do not think that because I'm using ETFs or ETNs in my investments, that my investment strategy is so-called passive. There's a lot of very active decision-making required.
Yeah. Vomera, I mean, the one thing that has been great about where we are in terms of, financial investments is that we have democratized people's ability to be part of the conversation, to be able to participate in the markets. I think over the years, people have thought it's only for people who have lots of money. However, because of this information that's come to the fore, and also building on what Robert has said, you can be overwhelmed with information. Is there a thing that you should be looking out for in terms of understanding why you want to participate in a particular ETF? I mean, Robert said, he asked his clients as a departure question, why? And some people may say, well, FOMO, fear of missing out. That's why I want to get into the ETFs. How do you deal with that when you, chat with your clients?
That's good, because I think the FOMO normally happens for the wrong reason at the wrong time, as a rule. So I fully agree with Robert. I think you need to start at the beginning rather than starting at the end. You need to say, what am I saving for? What part is this asset class or exposure that I want going to play in my long-term wealth or my short-term view? And then you only go and say, I want to pick an ETF. The wrong place to start is to go and all the ETFs on the JSE, let's sort by return, and let me go and pick one of the top 3. Because then you're going to get your US tech companies, you're going to get rhodium, and you're going to get some other obscure niche type play, rather than what Robert referred to as a core holding in your portfolio. And that's where you'll go wrong. So I think before you go and think about the niche and the highest returning product on the exchange, think about, why are you doing it? Are you saving for a goal, short-term or long-term? Do you think about constructing something for your retirement? So then asset allocation and thinking about equity and bonds is important. And only once you've established, I want equity, I want South African equity, then you go and say, what are the South African equity ETFs available? Let me look at certain criteria like return, dividend yield, fees to ascertain which is the right one. But then you've already made the decision on what purpose is that product going to serve in your portfolio. And I actually want to link on to Robert and Arena around active and passive. We did some research a month ago comparing SA equity indices to each other. So say as a SA investor, you've got a view, I want SA equity. That's not a simple choice to go from there, because you've got on the two opposite views on the J's, you've got the top 40, which is completely uncapped, biggest companies, and then you've got the SWIX capped indices, which is locally flavored, capped at a certain percentage. And those indices have got different exposure. One is more heavily weighted to resources, the other one more to financial and SA Inc. So the notion of buying an ETF being a passive strategy is, for me, a complete misconception. The delivery mechanism, i.e. the product, is passive, but the whole ecosystem and decision making around it is very, very active. And there's a role to play both for the financial advisor and for the well-educated direct investor.
All right, remember, keep those questions coming. Anything you want unpacked even further for you. You've got a fantastic panel with us, Narina from ETF SA, and of course, Weimar Ferreira from Stanlib Index Investments. Really hitting the mark there, not forgetting Robert, who is joining us virtually from F&B Stockbroking and Portfolio Management. Robert, let me come to you with this one, because Weimar, spoke about, how to pick a particular ETF. However, with all this information that was out there, we find fact sheets that are attached to a particular ETF that I want. And it's great if you know your why, but your fact sheet, some people may say, well, that's daunting. I don't even know where to start when analyzing a fact sheet for a particular ETF or an ETN for that matter. What information should I be looking out for in that particular fact sheet? What's important and what is just noise and I can basically disregard it?
Sure, that's quite a difficult question, because the problem with fact sheets is, the purpose of a fact sheet is to give you as much information and probably give you too much. So again, I'd come back, once you've answered your why, and exactly what was said, then you need to start unpacking it in terms of returns and fees. And we are all well known that past performance is not a predictor of future performance, but we do understand that there's enough history at the moment that we kind of can make an informed guess in terms of what the average return would be for an index over a certain period of time. So ultimately, depending on your why, you will probably need to end up looking at returns. Again, longer terms is better than shorter terms. This is the investing game is a long-term game with short-term fluctuations, and you need to keep that in mind when you participate in investing on the stock market via ETFs. The second thing is, as what John Bogle said, the two enemies of any great investment, the one we're discussing now is emotions, and the other one is costs. So you need to look at your costs as well. It's been one of the big benefits of ETFs going forward in the last couple of years, specifically as the lower cost of getting access to the market. It was mentioned, if you had to go, one option was to go buy 40 shares. The problem with that, the cost would be just exorbitant, first of all, and you'll need to do it every 3 months, and you will not have the benefit of costing, for example, like, at a One Invest or an Ashburton or Stanlib, in terms of costing parity with your broker. So ultimately, it boils down to fact sheets. The eyes will always be following returns, that is obvious. And then secondly, you should be looking at costs.
Narina, your thoughts? I mean, we're told, do your own research. People say, well, great, I've got the research in front of me, but what do I look at here?
Yeah. So actually, the very last thing I look at is returns.
Okay.
Because that's about the past. It's like driving my car and looking in the rearview mirror. I'm going to make an accident.
Yeah.
So for me, more important is about how do I link my why to the information that's available on the fact sheet. And that would talk to two things. One could either go almost in simple everyday terms, the investment objective that is always stated in the fact sheet, for example. The more sort of discerning or informed investor would look at things like, what is the asset class? What is the geographical region that's covered by this? What is the investment strategy? Is this a market cap weighted? In other words, is it about the size of the companies or the bonds that's in it? Or is this maybe a strategy that focuses on things like dividends or momentum? Or does it give exposure to a specific sector like technology or healthcare or whatever the case might be? So you've got to look at that component of information to try and tie it back to your why. And then, obviously, absolutely right, we agree with Robert in terms of the costs, but I think we need to appreciate also that not all costs are created equally also within this, and that you will always find that a more, call it a vanilla strategy, sort of your broad-based market cap weighted indices will typically have lower cost structures than your more sophisticated strategies that require a lot more IP, some intellectual property that goes into it and so on. The fact of the matter is that the costs associated with index tracking investments, ETFs, are substantially lower than those of actively managed products. So let's not just, fight about costs between 10 basis points or 15 basis points within ETFs, but rather consider the alternative. You spoke about FOMO earlier on, fear of missing out. The other famous one is TINA. There is no alternative. So as far as I'm concerned, there is no alternative to ETFs when it comes to the cost argument. But I think the final one also to consider is the other why might be, is this about growing capital, growing your wealth over time, or do you have an income requirement from this portfolio? And income, of course, can come in different forms. Dividends, it could be interest. So one could also start looking at things like, does this ETF actually pay out the distributions that come from the investments, or does it automatically reinvest it for you? We are now sort of moving down the sophistication curve, if I can call it that, in terms of how do we assess these. But all of this is information that is contained within the fact sheet. So identify what it is that you're looking for, what is your why, and then find those touch points within the fact sheet to identify what is the appropriate one. And just to reiterate, past returns is right at the bottom of my list.
Okay, past returns right at the bottom. Vemer, what have you seen when it comes to the shifts in methodology and the criteria that people take into consideration when ETFs are put together?
I guess that's a complex question. For different people. It will mean different things, because Robert spoke earlier about core satellite and thinking about having a core in local equity or bonds and then positioning around it. I think for other people that might be more familiar with the market, they might have a more adventurous asset allocation, if we can call it that. So I think the benefit of an ETF, it offers something for everybody. So if you want to have, if you go back to the most basic asset allocation long-term portfolio, it's a 60-70 equity, 30-40 bond, let's buy 2 products to get a balanced portfolio. That is possible if you want to keep it as simple as that.
Yeah.
Or if you want to go into the Reg 28 framework, which is the regulatory framework governing pension funds and retirement savings, is you can construct a fully Reg 28 compliant portfolio because you've got exposure to SA property, equity, bonds, foreign property, equity bonds, you've got niche indices, you've got commodities, you've got currency products. So you can go from the basic use to the most complex use. What we've seen in the US, and I think it's happening more and more in South Africa, is people are even using ETFs for trading. Yeah. And when I say trading, it is very much the short term versus the long term, and the why is important there. But to express a view on what the commodity price is going to do. Then you can go buy a gold ETF, a platinum ETF. If you want to express a view on what's going to happen to the European equity markets, you can go and buy today, sell it tomorrow. If it went up, you'll pocket the return. So I think the benefit of the ETF, it should serve, in my mind, it serves all purposes when it comes to investment. And that's, for me, is the ultimate benefit is you don't need to look further if you want to invest, even if you invest for different reasons.
Right. Robert, last year we had 20 years of ETFs in South Africa. And I'm curious to know, what have you learned over the years in terms of our South African ETF market versus the US? What are some of the differences here?
I think obviously the big question is, and Arena's probably, Weimar know the dates probably a lot better than me. I think the first ETF was issued in about 85 in the US. First index tracker started in 75. So the knowledge base is significantly more entrenched in the US in terms of investments, stocks, and ETFs. And it's also largely a function of the 401k, where you can manage your own pension money into actively. So in the first ETF in South Africa, Narina, you know the date probably better than me. I think it was about 2000, which is about 20 years now. So in terms of knowledge, it's been a journey, and working for a bank as well, ETF and EFT, you know, the acronym gets switched over numerous times. And I think, you know, one of the things that I've observed in the last couple of years that people are able to distinguish between an ETF and the banking transaction. So there's been a lot of good work in terms of education as well, and the likes of Marina and Mike Brown with ETF SA, you know, doing a lot of good work in terms of positioning ETFs. So there's a huge awareness of ETFs in terms of what we're seeing clients are doing at the moment. So our clients are getting a lot more adventurous, as Vaima said. We are seeing our clients moving away from local-based ETFs, and they're starting to add global ETFs. And it's largely on the back of exciting things happening globally. For example, there are robotic ETFs, there are cloud-based ETFs. We're also seeing clients getting more involved and insisting on ESG ETFs, so that's a big thing at the moment. And then we're getting a lot of requests, you know, in terms of these trading ETFs, but in the US they've got leveraged ETFs, which a lot of traders use. And then, it is happening out there, and we can't be blind to it in terms of crypto ETFs and, dare I say, maybe one day a non-fungible token ETF. So there's a lot of changes. So our clients are getting a lot more adventurous. Those are the self-managed or do-it-yourself clients. Where we manage money for clients, they've even come to us and said, okay, I'm willing for you to manage the money, but instead of doing stock picking, I need you to do an ETF portfolio for me. So that's quite a massive change for our portfolio managers as well, which was never the case. So we're seeing more and more clients insisting that their managed portfolios should be just purely constructed out of ETFs. A lot of change happening. I think, you know, and the big thing is, you know, that it's usually education and information, and sometimes they aren't the same. But in the last 20 years, where we've come from and where we're at the moment, that clients are adventurous and insisting that portfolio managers construct portfolios out of ETFs, we've come a long way.
All right, Narine, I'm going to come to you. I mean, you know, building on what he said, what have you seen in terms of the evolving nature of South African or SA ETFs versus what you've seen in the US?
Yeah, so certainly the South African ETF industry is one of the leading ones in the world in terms of the evolution of different types of ETFs that are available. I mean, one of the unique features, I think, of the South African ETF industry is the predominance of commodity ETFs, for example. Yeah. There's no other market in the world that has as big a part of its ETF industry represented in commodities. It makes sense if you think where the South African economy and the JSE basically come from. But I think where we've seen, there's almost for me three phases of evolution. The first phase of index tracking products and ETFs were very much your broad-based equity market products, and it was all about ease of access, low cost, you know, that efficiency really coming through. The second phase was when we started moving into other asset classes. So commodities like the gold ETF, bond ETFs. I mean, the inflation-linked bond ETF in South Africa was one of the first alternative or other asset classes other than equities also. And that really was all about providing access to other types of investments than just South African shares or South African equities through the same safe vehicle called an ETF. And the third one is really where it's now much more about what is the strategy of that underlying index. Where the first wave was all about market cap weighted and just broad-based stuff, we are now getting into a lot of those niches that VMA was talking about. Some of them fall under the term smart beta. Yeah. All that smart beta really means is we're going to choose stocks and weight them according to something other than size. So it's going to be on the basis of the dividends that they pay, or on whether it's a value basket, or whether it's momentum. But it's also exposures to these thematic trends that we see globally. Robert referred to things like robotics, for example, AI, biotechnology, all of these sort of trends. And we followed that same progression in the South African industry as well. I think maybe just a word of caution for many investors investors who do their own research, it is necessarily so that the bulk of information that you're going to find readily available on ETFs is going to come from the US. And I think a lot of people think that the South African ETF industry is very different to the US, and they're right. But it's not so much that we in South Africa are different. It's rather that the US is so different from the rest of the world. There are very specific tax advantages, cost advantages, access advantages, all sorts of advantages that the US market represents. Robert referred to things like leveraged ETFs, inverse ETFs, those sort of products are only available in the US and to US investors. So to do your research, reading about stuff that happens in the US and then feel that you should be able to do it here and getting annoyed because you can't, misses the point. Rather see what is available here and how you can use that. It's good to be aware of what happens in the US, but it's not the reality for us in terms of, for us here or in Europe or the UK or even in the East in terms of the ETF industries in those markets.
Well, we've got some very interesting questions that have come through, and I'm going to open the floor to them because we want to get through as many questions as possible. Remember, keep them coming. They look very interesting. And Vema, I'm going to have to go to you for this one. You're going to have to take it. The question reads, why is my financial advisor silent on ETFs, always plugging unit trusts? Is it a question of commissions? I mean, we spoke about the benefits of ETFs, but if financial advisors are not, bringing that option forward to their clients, what could be the issue?
I guess, Nastassia, there's a couple of reasons, and I think they are placed differently in different clients. But I think the majority is, in South Africa, financial advisors grew out of life insurance companies, and then asset management companies came about, and they were used to trading on platforms called LISPs, Link Investment Services Platforms. Those platforms at the moment in South Africa, majority of them only cater to unit trust because they can't accommodate ETFs or shares. So the ecosystem of the financial advisor is to do all his client administration on a LISP, and there's a reluctance to move my admin back office function from LISP to exchange. So I think there's a change management that needs to happen in the advisory forum to allow them to do that. And I guess that's where one of the main benefits of ETFs, like Nerina mentioned earlier, is accessibility. Because if you go to any platform, they've got preferred lists and closed lists and open lists, whereas the JSE is open architecture. Everything that is listed is available. If you go to FNB stockbroking, Easy Equities, Standard Bank online share trading, you can see all ETFs. That's the beauty. So I think that the advisory reluctance to move to ETFs is probably grounded in behavior and where they're used to operating. I do think the platforms being able to accommodate things like commission and advice fee, which, as we said earlier, there's still space for advisor to earn a fee because there's active decision to be made. That mechanism on some of the online share trading platform is possibly not available. So the advisor might want to move, but he can't move his client because the mechanism to charge a fee to his client, very openly and transparent, is possibly not there. So I think it's a combination of things.
Yeah. Robert, I'm going to come to you for this particular question. And I remember in the beginning of our discussion, you said it's about understanding your why. And I'm not sure whether you'll be able to tackle this one. It reads, what are some good ETFs to buy for one's grandchildren in today's market?
Gosh, given that I'm a very regulated person with so many rules and regulations, so ideally to answer that question, it's basically we have to do a suitability analysis to get to the why. But assuming that, these are the grandchildren are quite young, your safest bet in my view would just to be buying an index tracker that tracks the top 40. Set and forget, and maybe monitor it once in a while. But given the age of the potential investor, I would rather just go very risk neutral and track the index. Potentially, as the investor gets a bit more knowledge, then you can get fancy and you can potentially start adding the 60-30, bonds and and equities, or get even fancier, look at, specific thematics, commodities or robotics or AI. But my general question would be, and my general answer to the question usually is to start off simple, go with an index like the top 40, and then once you get comfortable over time, you can think about diversifying into other ETFs.
All right. Narina, the next question reads, what is the personal tax treatment on the sale of ETFs?
Oh, beautiful, wonderful. So the first type of tax that one would pay would be your dividend withholding tax. So if you are in an ETF that does pay out dividends, then there's the 20% dividend withholding tax. You as the investor don't even see that money. If the ETF pays out 100 Rand worth of dividends, 20 Rand of it is paid to SARS and you receive 80 Rand in your account. So that would be the first one. But I guess the more important and longer term one relates to capital gains tax. And that would be treated no different than any other individual share, for example, that you would buy, or for that matter, a unit trust investment that you would do. You would be buying it at a certain price, and at the time when you sell it, there would be an assessment to see what was the capital gain that you made. In other words, by how much did the price go up? And then there's all sorts of rules that kick in terms of how much is excluded, what percentage gets included, but capital gains tax probably is the most important one. But from that perspective, as I say, it's no different than any other investment that you would make, whether that is in a unit trust or whether it is in individual shares. Of course, we are assuming here that you're talking about investments in ETFs in a taxable account, so an ordinary investment account. If you're making that investment into the ETF in a tax-free investment account, then there are no taxes payable, neither capital gains tax, nor dividend withholding tax, nor interest tax or anything. Also, if that ETF is used to be invested inside a retirement fund, again, within a retirement fund, tax exempt. So it depends on the type of account in which you buy the ETF, but I suspect the answer really was about that first question, almost like an ordinary discretionary investment account.
Yeah. Vemara, the next question says, is there a one-stop shop or web-based platform in which I can see what all the ETFs are about?
Yes, I think there's various platforms. I think Narina runs one of those platforms, ETFSA, where she not only provides information on an aggregated basis on all of the ETFs, but also has the information from the issuers as well. So I think ETFSA is probably the best stop to go and see all information. There's comparison versus ETPs, ETFs, ETNs, they per asset class. So it's quite a neat place to go and see it. I think most of your platforms should also have price information on your ETFs, maybe not in as a neat one-stop shop as Narina. And I guess you can reach out to the JSE as well to get information on all the listed products with who is the market maker, who's the issuer, contact details, you want to get in contact with the manager, which I think one of your questions earlier was around interaction. I think more and more people are comfortable interacting with the issuer and the manager. So we encourage people that if they've got questions on the product, and we spoke about fact sheets earlier, fact sheets can be daunting. Like if you start talking fees on a fact sheet, there's an acronym for everything. If you're uncertain, reach out to the manager. The details should be there, and the manager should be able to answer it for you.
All right. Robert, the next question says, will an actively managed fund outperform an index tracking ETF if aggressive growth is assumed?
To answer that question, I need to go back to research, and the research suggests no. The research basically suggests that most active investors do not outperform an index. Even professional asset managers do not outperform. There are reasons why they not outperform. The problem with active is, again, if we just look at the JSE, you've got 403 shares. You need to do your stock picks very well. So that's problem one. Problem number two, there are costs. So every time you rebalance, you incur cost. Your third problem is the more actively you invest or trade, you could invoke different tax issues which aren't favorable. So unfortunately, to answer the question, how would I do it? So the answer is no. There's ample research which would go against this idea. But what I do suggest, if you want the raciness and the sexiness of buying the odd share, then you could think of it of a different way, where you would start with your core portfolio would be index or ETFs, go up to about 80%, and then for fun and to have something to talk at the braai, 20% actively managed.
Okay. Narina, the next question reads, let me just go to that. What is the maximum limit that one can invest in an ETF?
There is no limit. That's the beauty of it.
Yeah.
There are, in fact, hardly any minimum limits. You can invest a very small amount, but there's also no maximum limit in terms of how you can invest in either any one ETF or any combination of ETFs. A particular account type might have a limit. So, for example, a tax-free investment account won't allow you to invest more than 36,000 Rand per year, per tax year. In a retirement fund as well, there's limits in terms of the contributions that you can make. But all else being equal, investing in a particular ETF, no limits. You can go as much as you want to.
Before I get to the next question, let me stay with you for my follow-up then. Are you locked in an ETF?
No, that's the other beauty of it. Remember, we said that efficient bit of the efficient, transparent, flexible.
Yeah.
So an ETF being a listed security means that it trades on the JSE every single day, right throughout the trading day. It is a requirement of the JSE that every ETF must have a market maker. Veermeyer had referred to this previously also. The role of the market maker is really being the willing buyer and seller of that ETF product. So it means as an investor, you have the ability right throughout the trading day to go and buy or sell that ETF on demand. On demand also means that it is done at the net asset value. So the value of that underlying ETF is the price at which the market maker will buy from you or sell to you. There's a bit of a spread between the buy and the sell price and so on, but all else being equal, the net asset value is what you're going to get. Now that's an incredibly powerful feature of ETFs. Because if you think in terms of buying individual shares, there's no market maker for individual shares. So if I want to buy a share, I've got to hope that there's somebody else that's prepared to sell it to me. Or if I want to sell it, vice versa, who's going to buy it from me and at what price? The ETF, there's a willing buyer and seller all the time, and it is at the net asset value of that ETF.
Right. Veermeyer, I'm going to come to you because, Chief Operating Officer at Standard Index Investments. So I figured this one you might be able to answer. It says, how are life insurers and banks able to offer even lower priced synthetic index tracking investments?
It's a good question, and I think we touched on it earlier. Is something issued by a bank, which is normally an ETN or a life insurance company in the form of an insurance product, is issued off their balance sheet, or they are putting something out in the market and saying, if you buy it, I promise you that I'll give you your money when the term is up. And normally these products have got a term structure. Endowment's got a 5-year. ETNs on the JSE normally has an expiration date of 5 years. So at the end, I promise I'll pay you back. Whereas the ETF is saying, I'm not going to promise you I'm going to pay you back. There's the money, it's yours. If you want it, you can sell it and it's yours. So there's the promise component that is gone. In terms of the fees, the reality is for that promise, you are giving them money. The life insurer or the bank is going to take that money and try and replicate that return that they're going to owe you in the future in some other way. And in the South African market and global markets, there are ways where you can invest in futures, put money on deposit, earn a bit of extra fee, but you take the risk, so you can charge less for it. They don't pass that risk on to the investor. They bear the risk, but they are rewarded for that risk. And that's why they can reduce the fees. But again, for reduced fees, you're assuming as an individual some additional risk, and you need to be aware of that risk when you assume it. Normally, we just spoke about fees and when you get out. The beauty of an ETF, as Narina said, there's no upfront fee, there's no exit fee, there's no penalty. It's yours. You can realize that if you invest for the right reason, but something unforeseen happens like COVID last year, you've got access to your money without having to go and ask for, can I please get my money back? And that's also the difference between an on-balance sheet and an off-balance sheet. On-balance sheet being bank, life company, off-balance sheet being the money is yours, it's there in an account for you.
Right. We've got the last few minutes left. Just a reminder, if there's any part of this conversation that you may have missed, we will upload the full conversation, so you can always go back and listen to some of the answers. Robert, I'm going to come to you for this particular question, and it sounds like such a simple, basic question, and I think it's so important because that's how one gets started, I suppose, in their financial journey. And the question reads, I don't know where to find a financial advisor and would rather want to do this by myself. How do I start?
So the process is quite simple. So to purchase a ETF, you need to open up an account, a stockbroking account. So you could go to any of the online platforms, being it ourselves, FNB, Standard Bank Online, Easy Equities. And once you've opened up an account and you've funded the account, then you need to execute and purchase your ETF. So it's quite simple. It sounds quite simple. The opening is usually quite a simple process. I think the challenge actually comes in terms of hitting the return button, in terms of buying the ETF for the first time. But most platforms are quite user-friendly. And again, I think you need to be quite sure once you've opened up an account, it's funded, you need to do a bit of homework in terms of what ETF you are planning to purchase, that you make sure once you enter the correct ETF. And usually with a lot of platforms, they've got separate menus where they indicate where the ETFs are, and you can just press your button and purchase. And the same is for selling an ETF. Again, you can only sell what you've put in, obviously.
All right. So as we take the last question from the floor, as we get to wrap up the event, we are going to be taking some closing comments from our panelists, where they'll be sharing tips and things that you can be thinking about as we wrap up the event. But before we do all of that, Narina, there's a question that's come in here. It says, please provide data from quantitative research regarding long-term return after costs when one compares an ETF and an equivalent unit trust. How do active asset managers justify their existence?
So I think very important there is to understand that when we are doing a comparison between an ETF and an actively managed fund, it needs to be within the same asset class, the same type of investment, in other words. That's where Robert alluded to it earlier, and I think probably one of the best known pieces of quantitative research is the biannual SPIVA report that is published. SPIVA stands for S&P Index versus Active. So S&P Dow Jones every 6 months publishes a report that looks at the performance of the actively managed funds in a particular market and against the broad benchmark index of that market. And it is through that type of statistics, not just in South Africa, globally, that we find somewhere between 70 to 90% of actively managed funds underperform the relevant benchmark. How do you justify that cost? Well, there's always that allure of maybe I'll be the one that chooses the outperformer. Of course, there will always be some actively managed funds that do outperform the index. The problem is that you never know in advance which one of the thousands of actively managed funds out there is the 1 or 2 or 5 that will outperform in the next period. And I think that's where the challenge for investors come from, and why investing in the index fund, you are guaranteed over the longer term to have a much better success ratio than you would have with an actively managed fund.
Robert, we've got about a minute and a half, and I suppose in about 20 to 30 seconds, one tip that you want our viewers to be able to walk away with at the end of this.
It's an old stockbroking or trading tip, which basically says time in the market is more important than timing of the market. So people should not worry about, is it the ideal time, is the market overvalued? They should start now, and they should keep going as long as possible.
All right, Vemer?
I'm going to say, I think we spoke about a lot of product and the choice conundrum, but I'm going to link back to Narina's car analogy. Think about the engine and wheels first before you think about the CD player and the tinted window. So focus on the important stuff, local equity, local bonds, foreign equity, before you start thinking too wide.
Narina, your tip?
It's not even really a tip. I think it is about appreciate the fact that ETFs are so transparent, that there's so much information available. Don't be afraid of engaging with it. Learn. listen to podcasts, read blogs, read the fact sheets, engage, talk to your friends about it. You learn best, coming back to the car analogy again, you learn best by actually getting into the driver's seat of the car and driving it. And you can do so with a relatively small amount of money without blowing up the bank. And so I really would encourage people, learn and then apply, take action and just do it.
And certainly action will be taken today. Thank you so much for joining us. Fantastic panel. Thank you once again to Robert van Eyden, who is the CEO of FNB Stockbroking and Portfolio Management, joining us virtually. Thank you to Narina Visser, who is the director and co-owner of ETF SA. And of course, next to me is Weimera Ferreira, who is the Chief Operating Officer at Stanlib Index Investments. Do remember, you can watch the full discussion after the show and also catch up on the last 2 events that we had earlier this month. Thank you so much for tuning in. Until next time, goodbye.
Thank you.